When I was a practicing CPA, I was often curious when it came to a client's life insurance portfolio, who was running the show? The simple truth was that often there was no longer an active agent assigned to the client's life insurance policies. They were, just on autopilot, going through life's busy, complicated intersections with no traffic cop. These policies are sometimes referred to as orphan policies because without active management, life insurance can become a client's largest unmanaged asset. When a comprehensive review was completed, there were often several surprising and even sometimes unsettling discoveries. I remember a time when, as part of the review, we provided a list of current policy beneficiaries. The client was part of a blended family with many planning challenges. What was on file with the insurance company was quite a surprise, especially to Dad. While this led to some tense discussions, the beneficiary designations were updated and coordinated again with the overall estate plan. In other situations, the missed premiums were identified. As a result, the policy guarantees had changed, which impacted the longevity of the policy. Catch-up premiums, where possible, often created a financial challenge for the family. Another common example is those collateral assignments on expired loans. From our experience, when policies are owned by an irrevocable trust, complexities expand. For instance, imagine a scenario where the trust grantor, i.e. the source of cash gifts to pay premiums, dies before the person insured by the trust-owned policy. This results in a trust owning a policy without a source of funds for future premiums. Now, others may be asked to help resolve what is an unanticipated cash flow crisis. In fact, Todd, the success of the grantor's estate plan is dependent upon these proceeds being received from the trust.
Absolutely, you're right, Carolyn. And you're aware of the fact that my mother-in-law died at age 99 recently, and we were fortunate to have her live that long. But unfortunately, her policy didn't live that long. It died when she was 95, because at the time she bought that contract, insurance companies figured that at age 95, everybody would be dead. As a result, the insurance contracts didn't extend beyond that age. Lots changed since my mother-in-law bought her policy. While some of those policies may still be in force that were issued to age 95, today's contracts may be purchased that will go all the way out to age 125, and sometimes beyond. However, many of those policies purchased within the last few years may not last that long, not because the contracts didn't allow for them to, but because of lower than projected interest rates on those policies. Another thing that's changed is the type of policies that are available today. As a young life insurance agent, I only had to learn two basic types of products, whole life and term. Today we have at least 30 different types of products and immeasurable options within those products. When universal life was first introduced, crediting rates were around 12%. Today they're around 3%. Celeste, with those kinds of changes, these policies need constant monitoring and management.
You're absolutely right, Todd. And throughout my career, I've seen thousands of product changes, multiple insurance companies sold or restructured, crediting rates increase and decrease, and both more liberal and more restrictive guidelines when it comes to medical underwriting. Through it all, the one thing that has remained constant is the lack of adequate policy monitoring to properly navigate these changes. With our firm's collective experience, we have developed a thorough policy review process that helps us proactively monitor and protect your clients' policies and adjust them as goals and objectives evolve. We utilize a due diligence process that includes comprehensive vetting of companies and products based on verifiable market analytics and thorough research of options and product suitability. As part of this process, we've incorporated two tools that help us measure the competitiveness and appropriateness of products for each client's specific situation. The first is Veralytic. It's a third-party company that gives products an appropriateness rating based on 5 different criteria: the financial strength and claims-paying ability of the insurance company, cost competitiveness of the product as compared to current product offerings, pricing stability, relative policy value, and historical performance. The rating is coupled with an in-depth summary that explains the score for each of these criteria. The second tool is Life Trends, also a third-party company that provides up-to-date product pricing information, market research, in-depth product analysis, and independent, unbiased product reviews. Our policy review process, coupled with these industry-leading tools, provide measurable recommendations that are customized to fit the client's specific goals and objectives. And because coordination is a key component of the value we provide, we collaborate with the client's advisors to ensure coverage is aligned with the rest of their planning. At C3 Financial Partners, we look forward to helping your clients gain clarity in their goals and objectives, confidence that they're making the right decisions, and help coordinate with you and their other advisors.